brokers on. What is a CMBS? How is it? How does it work? Why is it different than a traditional loan that you would get from New York Life or MetLife or Citibank or any of these places or Chase? And then we're going to talk about how does it affect the tenant in his negotiation? How does it affect the broker? Sorry to say this, our commission. How do we get paid at the end of the day? We do this for free. What is the thinking of the servicer? I'm going to get Michael Cohen to start speaking about what is a CMBS loan, how does it work, and one last thing.
So CMBS was really formed in the late 80s to in the early 90s to take all the loans from the RTC and the savings and loan crisis and package them and to put them into bonds. The biggest difference between CMBS and really balance sheet lenders, which are insurance companies and pension funds and banks, is that you're securitizing them, you're closing the loan and then selling them into the bonds.
Yes, thank you.
Yeah, and then once you sell them into the bond, you're now dealing with a number of different parties in order to try to fix it. There's no relationship. I mean, that's really the bottom line. There's certain pressures that the balance sheets have where they're regulated by the Fed, so the Fed can say do this or don't do this, or we're going to criticize you and hold more. Versus the CMBS lenders and when it's bondholders are really dictated by whoever the bondholder stack is and what the pooling and servicing agreement says they can do. So really the bottom line is when you're dealing with the CMBS, you're going to get a non-recourse loan, but the issue is going to be that when you're if there's an issue with the loan, you're going to have a lot more complicated issues to deal with. From the perspective of what and why from your perspective of, hey, I'm trying to do my best to bring the tenant into the best building that's going to work for my client, as well as a building that the ownership's going to maintain and I'm not going to have issues with the loan. There's a few things that you can look at and this is really where securitized loans actually get a little bit are more transparent than a balance sheet loan, because a balance sheet loan you can't get into knowing this information. All the information or essentially a majority of the information on the loan and some operational information can be found on a system called TREP that reports all of the loan data from the servicer, including comments. And that's what I'll kind of talk about right now is what I look at from there. You could do it from CoStar. You can do it from, we wrote that there's a list of different ones, but I'll get to that. But I thought right now, if it were me, I'd be looking at the loan details of seeing what you guys are going to know the owner, you guys are going to know the building, and you're going to kind of know what's going around at the other buildings. But from the building perspective is to understand when the maturity date is of the loan. So you want to know, okay, if there's 2 years left on the loan, but I'm signing a 3-year lease, what happens? Is this going to be someplace where the owner's still going to have control of the property? You really want to know who the loan special servicer is, because the loan special servicer, each one is different. Each one of those, the special basically have in a bank relationship, you have your loan officer, and then they talk to the credit people and they get back to you. And at CMBS, you have a master servicer who's going to be a Wells Fargo or a PNC Bank, and they're the ones that are doing the administrative things. And then if there's an issue with it, they go to the special servicer. And the special servicer could be an LNR or K-Star or Rialto or the Eightfold. And those are the ones that are typically making the decisions if they are in control of the bonds. If not, there's a controlling class holder, which is the lowest person in the stack that they have to speak to. So just imagine you're not talking to one person. There's no one-on-one negotiation here. Everything has to be in writing. Everything has to go through a process. And when you're dealing with special servicers, there's some special servicers that are more aggressive than others. There's some that would love to just take your property. They see it and they're going to make it difficult for you. Some like to get as many fees as they can get. Some will say, you know what, let's just let's just modify your loan and make it best for the trust. So there's a lot of things at play here when you're doing this. You want to understand also what the total exposure for the lender is currently, and we could see that in TREP. We could see how much the servicer is advanced, how much the loan is delinquent, how much did they pay their taxes and insurance. So you can see the health of the building that way. You look at delinquency history. Has the borrower been paying on time? Are they 90 days late? Have they been late? You know, are they just kicking along here? You also want to look at the if they've done they have a summary financials, and so you can see, are they below the debt service coverage ratio of a 1.0, meaning they can't pay off their debt service. Are they below there's triggers in the covenants of the loan that say if your property goes, so for example, below a 1.25 debt service coverage, what happens then? You're at a full cash flow sweep. That means that you submit to the bank your operating expense budget and they pay it. So all the money goes to the bank, the owner loses some control. There's a commentary page in there as well. So you can see what the dialogue has been going back and forth. Is the borrower being contentious? What are they doing? And then you also can look to see what the value of the current value of the building, if they're below water or above water, based on what the lender is seeing, and that's how they're going to deal with them. And all these are important to you in order to see it. What we do as a business is we fix these loans. We go in and work with the borrowers to represent them and their attorneys to speak on their behalf, so we can just keep it on the business level and see if we can cut a deal with the bank. What happens?
So I'm going to share my screen for a minute, if that's okay.
Sure.
One of the pieces of information that is also publicly available on the TREP website is securitized loans. Securitized lenders take a lot of reserves to make sure that there's cash flow available for the operation of the property. And one of those reserves for a building that has vacancy will be a TI and leasing commission reserve. So one of the data points that you'll be able to examine is how much money that lender is holding for leasing, for those major capital expenses to lease up the owner's building.
You see that on the TREP?
Yeah, you see that on the TREP.
You can see that on the TREP. So now, of course, they only have to make those, and they'll have a repair reserve, they'll have a capital replacement reserve. If they've identified, physical issues on the engineering reports, they'll take reserves for that. So that information will be available. Now, of course, they only need to make those reserves available if the loan is not in default. So we're in this environment where a lot of buildings are underperforming, the analysis of the suitability of the building becomes a three-dimensional analysis. And it's not only, the landlord and the tenant, but the lender's participation may be needed. Now, to Michael Cohen's point, there may, when there's a portfolio or a balance sheet lender, when it's a MetLife or a New York Life, there's going to be someone there to talk to. But when you're dealing, especially with a special servicer where there's a problem loan and it's been referred to the special servicer is bound by a lot of masters and sometimes is less responsive and is nervous about making decisions. So they can be notoriously unresponsive. So from the broker's perspective, you really want to look at this public information that Michael touched upon, and there's a vast amount of information there. And we talked about special servicers versus master servicers, and there may be fees associated with getting this special servicer to participate, but also every deal, has its own timeline. Your customer has a need, okay, and they need to fill that need on a timeline. And so getting these servicers' attention can be challenging. And again, that's where Michael Cohen and his team at Brighton Capital Advisors, can come into play because he knows the people and the players, and he can help you, bring them to the table. So again, the other diligence items you're already familiar with. with your basis of experience. And these are some of the resource materials that you may want to look at when you're evaluating the building.
Michael Pollack, can
yes,
you
sir.
just go back one?
Go back.
Just one. So with CoStar has the TREP data, so you can see CoStar has the same data as TREP, some of the same data. You can look at the debt to service coverage or the loan value or the interest rate, and you can pick that up there. The DOB, Evan Schneider's on the phone. We had gone through one together, and you can see if there's violations on the building. Are they keeping up with the elevators? Are they doing their local law work? Are they filing for Local 97? You can start to
Boiler inspections. There are tons of potential violations. Work in the building that had stop work orders. There's a lot of things that give you an understanding of the complexion of how the building owner manages the building and what the quality will be for the tenant. And we're always looking for that. And there's a lot that's revealed when you go into the DOB violations.
Sure.
Sometimes you get a clean building, and sometimes you get things where elevators haven't been inspected in several years, and they continue to carry the violations and don't resolve them.
And we can have a separate conversation about TCOs, but that's another
Right,
topic.
Oh, yeah.
All right, moving right along.
Moving right along. So how do we secure the commission? Well, we talked about, right, the reserves that the securitized lender might be holding, and you can look at that on the TREP report. You know, some big tenants will insist on the right to pay their broker and offset it against the rent if the owner doesn't pay. Of course, getting 100% of your commission on signing is helpful. And we know that there's a lien law in New York that protects brokers, and there are a couple of conditions that have to be met. Of course, New York protects brokers who deliver a ready, willing, and able tenant, whether they have a brokerage agreement or not. But of course, owners like to have brokerage agreements for that reason, and there are advantages to the tenants to having brokerage agreements as well. I have my partner, Kirk. Brett is on the phone. Kirk, would you like to weigh in on this point?
I just wanted to add just a brief note on the broker's lien and the commission structure, the structuring the commission payments. Look, there aren't a lot of bankruptcies of landlords of buildings, pure bankruptcies as opposed to deeds in lieu or mezz foreclosures. But of course, if there is an actual bankruptcy, having a lien, a filed lien, is enormously helpful so that you can, not be in the same category as all the general unsecureds. And then the other thing is that to the extent you obviously getting your commission due at signing, getting 100% of it paid right away is best always. But if you have some kind of deferred payment structure, having the lien to support that would also, help in the event there's a subsequent bankruptcy of the landlord, and then the landlord seeks to recover some of the prior payments as preferences. Okay, so and I don't know if you.
All right, so if there's a payment schedule, let's say you get paid over let's say 3 payments, you get the first payment, you can't file a lien unless you don't get the payment, right?
Right.
You can't.
Right. Right. And of course, the brokers are loath to do that because, of course, you'll damage your relationship with the owner going forward.
Depends on the owner.
Well, that's true too. But in a situation where, you could see that if that building seems to have potential to file bankruptcy, it's a good protection for the broker. Of course, that lien may still be subordinate, to the mortgage lien, but at least as a secured creditor, you as the broker have an enhanced position. Because the unsecureds typically get less than the secureds.